If you've already worked on your investing mindset and learned about the main asset classes, now comes the crucial step. How do you actually start investing? And do it the right way. In this video, we'll go through how to build a solid strategy, structure your portfolio, avoid beginner mistakes, and finally make your first investment. Stay tuned until the end, where I'll take you through the entire process, step by step. The content of this video does not constitute financial or investment advice in any legal sense. The material is intended for educational and informational purposes only. Investment decisions should always be made based on your own research. Before investing any money, you need clarity. A successful investment strategy isn't based on instinct. It's built on clear goals and principles. The first question is simple. What do you want to achieve with your investments? Do you want to build long-term wealth, gain financial freedom, or simply protect your money from inflation? One of the most fundamental concepts is the risk-return relationship. Every investment involves a certain level of risk, and in return, you get the potential for higher returns. There's no such thing as a risk-free profit, so the key is to find your personal balance between risk tolerance, meaning how much volatility you can emotionally handle, and risk capacity, meaning how much you can afford to lose without affecting your financial stability. Your strategy should reflect both. Someone young with a steady income and a long-time horizon can take on more risk than someone approaching retirement. The most important principle is long-term over-timing. Short-term price fluctuations are normal, but over time, the probability of losing money decreases significantly. Another core principle is regular investing. By investing the same amount every month, you automatically benefit from the cost averaging effect, buying more when prices are low and less when they're high, which smooths out your entry price over time. And finally, diversification. Spreading your money across different asset classes, industries, and regions. This is one of the most reliable ways to reduce risk without sacrificing returns. Once you know your goals and risk profile, it's time to structure your portfolio. There's no single perfect allocation. The goal is to find a balance that matches your situation. From an academic perspective, there are three main types of portfolios. A. The conservative portfolio. This approach focuses on stability and capital preservation. Most of the portfolio is invested in government or corporate bonds, with smaller portions in equities and possibly real estate funds or money market instruments. Long-term returns average around 3 to 4% per year, with relatively low volatility. It's suited for people with low risk tolerance or shorter investment horizons. B. The balanced portfolio. This model combines safety with growth. Around half to two-thirds of the portfolio is allocated to equities, while the rest goes into bonds or other stabilizing assets. It smooths out volatility while maintaining decent growth potential, delivering 5 to 6% per year over the long run. C. The growth portfolio. Here, the focus is on long-term growth. Most of the money goes into equities or equity funds, with small portions in commodities or real estate funds. It's riskier, but offers higher potential returns, typically 7 to 8% per year over time. Regardless of which type you choose, a good portfolio should always be diversified. That means spreading investments across industries and regions. For example, across North America, Europe, and Asia. Including emerging markets can also help, since these regions often grow faster, but with more volatility. This global and sectoral diversification significantly reduces overall risk, since different markets don't always move in the same direction. When you're starting out, it's crucial to avoid the common traps that have cost many investors time, money, and confidence. First, don't try to time the market. Many people wait for the perfect moment to invest, but that moment doesn't exist. Studies show that a large part of total returns comes from just a few strong market days. Missing those days by waiting too long can drastically reduce your results. The smarter approach is to invest consistently and regularly, no matter the short-term noise. Second, control your emotions. When prices fall, fear takes over. When markets rise, greed kicks in. These emotions make people buy high and sell low, the opposite of success. Having a clear plan and sticking to it helps you stay rational through the ups and downs. Third, watch your costs. Fees for funds, brokers, and transactions may seem small, but they add up. Even a 1% difference per year can cost tens of thousands of euros over decades. So remember, the simpler and cheaper your portfolio, the better. Fourth, avoid lack of diversification. Putting everything into one stock, sector, or country exposes you to unnecessary risk. A well-diversified portfolio reduces volatility without lowering returns. Fifth, don't skip the emergency fund. Many beginners invest all their savings and have nothing left for emergencies. That forces them to sell investments at the worst times. A golden rule is to always keep 3 to 6 months of expenses in cash or a savings account. Now let's get to the exciting part, how to start in practice. Here's a proven step-by-step process. Step 1. Define your goals. Write down what you're investing for, over what time frame, and how much risk you can take. Clarity will keep you focused during market volatility. Step 2. Build an emergency fund. Before investing, make sure you can handle short-term expenses. Without a safety net, you'll be forced to sell investments at bad times. Step 3. Choose a suitable brokerage account. Compare fees, user experience, and available products. Look for transparent pricing and automatic investment options. Step 4. Create your portfolio structure. Decide how you'll allocate your money across asset classes like equities, bonds, or real estate funds. A good core portfolio often combines global equity funds with stabilizing assets such as bonds or money market funds. Step 5. Start with a regular investment plan. Set a fixed monthly amount to invest, for example, at the beginning of each month. This helps you apply the cost averaging principle and grow your wealth steadily. Step 6. Review your portfolio annually. Once a year is enough. If your allocation has drifted, rebalance it back to your target mix to maintain consistent risk levels. Step 7. Stay long-term. Investing is a marathon, not a sprint. Short-term swings are normal, but patience, discipline, and time are the real sources of success. By following these steps, you're already ahead of most people, because the greatest achievement in investing isn't beating the market, but staying invested consistently. Investing means taking responsibility for your own future, with patience, knowledge, and a clear strategy. Once you understand the basics and take your first step, you've already done the hardest part. For specific recommendations, feel free to check out other reputable channels or wait until we release an explicit video on the topic. In the next video, we'll be back with an update on the most relevant events of the week. So subscribe to the channel to make sure you don't miss anything and start your personal journey now.